Good afternoon, everyone, and thank you for joining me today in this webinar, and thanks, Jen Egypt, for putting it together. My name is Ash Rafael, and I will be your host this evening. I will go mainly through a presentation. I'll introduce my company and introduce myself, and we'll get straight into the topic. So thank you for being here with us. My company is Open Air Venture Capital. We're a startup accelerator and early stage investors. I'm based in Washington, D.C. I am Egyptian American, but I've been in D.C. for the last 35 years. We run our accelerator for startups in Washington, D.C., in Denver, Colorado. We're launching in Egypt. We have presence in Zurich, Switzerland, and also in Chennai, India. What we do, real brief with our accelerator, we fund startups at very early stage in the areas that we are present. Funding is in terms of cash. We're a little bit of a different type of accelerator where we also give our startups a lot of resources. So they get developers, software engineers, QA, product owners, if they don't have them. We partner with Amazon, so they get Amazon hosting, about $10,000 a month. They get legal services. They also get business development, digital marketing, and PR through firms that we fund to support the startups, and mentorship. Our mentorship is not the common mentorship. We have a small group of executives that all have grown and created companies. So the startups get one-on-one sessions with with those executives. So the goal for this presentation, as you kind of see the title, the 5 or 6 counterintuitive decisions that entrepreneurs or startup founders make, is the goal is not to give you answers or solutions in an hour, but my goal at the end of the presentation is that if you walk away asking yourself more questions and exploring more answers, rather than finding an answer in the next 35 to 40 minutes, for example. A little bit about me personally. I'm a geek, a technologist. I have a PhD in artificial intelligence from University College London. I've authored 4 books and hundreds of articles. As an adjunct professor at the Johns Hopkins University here in Maryland, where I was overseeing dissertations for master's programs, dissertations. I have built everything, several companies, all organically. So as a VC, I actually have never in my past raised capital. First company we sold was for $75 million. Started a second company, we took it public. We've sold 6 companies, less than a couple of $1 million. And the last company, which actually does have presence in Egypt, was sold for $100 million. We started our firm also organically, without raising capital from limited partners or institutional investors about 2 years ago. And I'm also chairman of a publicly traded company here in the US that we leverage to do a lot of mergers and acquisitions of smaller companies and roll them up into our portfolio. So the discussion is about the 5, maybe you've seen it, 5 counterintuitive decisions that impact an entrepreneur success. And again, every time I see something, an article says the 5 topmost, or the 7, or the 10, or the 12, obviously they're not limited to these 5 things. So we're just scratching the surface in terms of the entrepreneur's life and some of the counterintuitive decisions that maybe entrepreneurs or startup founders are not aware of, and they go kind of through the trend of what is intuitive rather than what is counterintuitive. So before kind of the session, I looked, kind of did a quick search on, the top 5 most, sometimes people call them qualities, characteristics, traits, behaviors, to be a successful entrepreneur. So, I've listed as many as I could find in different articles and different opinions and videos. And, a lot of them will probably not surprise you. You've probably heard or read before. They range from being creative to how to network, determined, self-motivated, strong work ethic, persuasive, disciplined, and maybe one of the common ones that I hear all the time is have passion. Obviously, being decisive, visionary, confidence. And if you look at all of these, it's kind of hard to imagine that all of these qualities, characteristics, or traits and behaviors really exist in a single person. You'd almost have to be a Greek god to have, perhaps all of these different qualities. So to me, these are all texts, and they all can be summarized in what's called the X factor. There is something about an entrepreneur that they may possess some of these characteristics and traits, and others don't. But it's important to really understand that no single one or no combination of some actually make up a right entrepreneur. I think entrepreneur is and as you can imagine, we've seen hundreds of entrepreneurs that come, through our company. Startup founders looking for capital, looking for advice, looking for connection or distribution, or anything to kind of help them grow their business. So we get to see a lot of characters. We see a lot of traits. And even collectively, even working with other VC firms and in terms of trying to find, what is it that you look for in an entrepreneur? And it's very hard. Everyone has their own lists. Everyone has their own priorities. One thing that is absent from here is like coachability. So we all look for someone that is coachable, someone that can grow and can adjust and can pivot when it needs to. So you have to understand that all of these are texts. And for me, similar to kind of intuitive or counterintuitive behavior, a text without a context is a pretext. And that's really a very fundamental missing link when reading a lot of these, or when listening to even people like me or others talk about, the top 5X or the top 7 or whatever the topic is. Absent context, a lot of these just free-floating texts can be very deceiving and can be very disruptive. So what is a pretext? And the pretext is really a reason given in justification of a course of action that is not really the real reason. So it's hard to understand when someone throws text at you without putting the context around it. What is the real reason behind that text? What is the real reason that some of these characteristics or traits kind of come into play? And that's really a question for you. A question for you to explore a lot of these texts that you see, a lot of the advice that you get, whether you are already an entrepreneur or want to be an entrepreneur, contemplating some sort of a venture or some sort of a pursuit of an idea, is in reading this, it's hard to take it and say, I need to be a person of passion, right? Because passion is really sort of undefined. I get a lot of people say, I'm very passionate about my idea. And the question to me is, what do you mean that you're passionate about your idea? What is that going to return? What is the result of that passion? How do you actually put that passion in a context? And we don't have time, obviously, to go through all of these different traits and create context for them. But we can even take just one and say, if you're passionate about your idea, what is the reason? What is the context behind that? Because you want to make money from this idea, or you want to actually make a big impact, or you want to grow a company in terms of size or revenue. What does that passion mean? This is why I said earlier, is the objective is not really to answer any of these questions here in our session, but the goal is for you to walk away and asking yourself the what, why, when, how questions to understand even one little thing such as passion. So to me, when someone comes and says, I have a passion, I have a certain assumption, a certain expectation of what that means. And to have a passion, it tells me that you not only believe in your idea and want to pursue it, but you also are very competent in the solution that you're trying to put together behind your idea. So in a sense, you understand that market very well. You come out of that market, you've lived in it, you understand every single problem that faces that market. You have solutions to these problems, you've validated this solution, and you really believe in that. And that's the difference. And believe it or not, something as simple as that. A lot of entrepreneurs have the wrong passion. They have the passion to be rich, which is not in a sense bad, or to be famous, or to grow a company, or to hire people. Those are not wrong passions, but they're not the kind of passion that would allow you to be a leader in what you wanted to build. So understanding something as simple as taking one word, putting context around it, and being able to validate and drill down on where exactly that passion, the root of that passion, and where can I take it, is the healthy exercise to take any of those 23, I think I counted what I threw up on the slide, and drill down on every single one of them and answer the question and understand the context behind it. So now we get to the point of this counterintuitive reasoning. Every entrepreneur, or a lot of the entrepreneurs and startup founders that I meet, they have an intuitive reason of why this venture or this initiative or this idea will actually flourish or take off. But if you look at some, and there are thousands of examples. I just wanted to throw in some examples of ones that we are all familiar with. And we look at them from a counterintuitive perspective. When you look at Microsoft, and when Microsoft started, and the question was, well, this doesn't make sense. Who would ever want a personal computer on their desk? What is it that they're going to do with a personal computer? That's really doesn't sound too intuitive. That's, as a matter of fact, counterintuitive. When you look at Apple, and Apple was not the first one to come up with a phone. There were several companies before Apple that came up with a phone, but the counterintuitive behavior here was that we need actual buttons to push on in order for us to use a phone. So the counterintuitive behavior here is that, no, you don't really need buttons. We need to create a screen and everything will be touch. Well, that's really very counterintuitive because we're all used to the BlackBerries and the Nokia phones and the big phones that have buttons that have responsiveness to the push. So was another counterintuitive reasoning behind Apple. Amazon, in the middle of all of the different brick and mortar physical stores, people going someplace to try something, or people, when Amazon first started, wanted to go to the library to read a book and physically handle the book and put it back and look for it, or buy any product. When Amazon was initially looking to grow beyond sort of their book sales and into toys and electronics, people were saying, well, why would I want to buy a toy online? Why would I buy an electronic? I have to kind of go and physically handle that in order for me to do it. That was counterintuitive to the norm of people going out to shop and physically touch. Facebook, again, who would want to air their personal, intimate moments and share how they feel, what their social status is, or show pictures of their kids to the public? That's a private event. That's something very controlled. Why would I want to share it with the public? Again, another counterintuitive reasoning to people not wanting to do that. The list goes on. Who would want to open their homes for some strangers to come and live in there? Who would want to get in a car that is not a taxi or a friend that would take them somewhere? All of these were counterintuitive reasoning. And sometimes with a lot of entrepreneurs, you start thinking of what is intuitive, what is natural, and we really forget what is really counterintuitive, what is not natural, but is actually where the idea lives. And this is where the innovation is going to grow and flourish. So that's, I'm setting up kind of your mind to start thinking in a non-traditional way, in this counterintuitive way that may not make sense to a lot of people, but actually this is where precisely innovation lies. So when we get into the counterintuitive thinking, which is really kind of the topic at hand here, I wanted to discuss several things. And again, please don't limit them to 5 and take those as doctrine and those sort of the things. Those are examples. I can't overemphasize enough that I would consider this session or this, interaction between us as really is scratching the surface for you to go and ask more questions and find more answers. There's always the intuitive way of saying for entrepreneurs and startup founders of wanting to be the first. It's important to be the first. I think the counterintuitive behavior to that is it's not important at all to be the first. Sometimes it's more important to be last. Apple was not the first when it came up with the phone. Apple were the last to come up with a phone that completely changed the dynamics of the industry, completely changed the user interaction, the user expectations. But if you're going to come last, you want to make sure that there's no one else is going to come after you and be able to compete with you. Kodak was first. Where is Kodak today? Radio Shack, the first electronics place where you can go get anything from a wire to a microprocessor, to a walkie-talkie. Blockbuster was the first here in the US where you can go and rent movies. Polaroid was the first to actually give you instant pictures the second you take it. There are hundreds of companies that were first, and hundreds and thousands of companies that died being first. So this idea of being first is a counterintuitive idea. And none of these counterintuitive ideas suggest the opposite. The suggestion here is that it's better to be last than first. The goal here is to maybe move you away from the idea that you have to be first. That's really the goal, by thinking being last is really not a bad goal to have, as long as you understand the work and the consequences and the definition of what being last is, like Apple has. So that's one counterintuitive behavior. To me, as a venture capital firm, and we give money, and again, our model is a little bit different. A lot of entrepreneurs and a lot of startup founders think that raising capital is the most important. And I can tell you, for me, how dangerous that is. I've always said that VC money is a drug that you can actually overdose on. You should not depend on VC money. But unfortunately, we do live in a world of tweets and TikToks, and people read headlines and not really necessarily interested in the details. But there are dozens of companies that have become unicorn. We're not even talking about the tens of thousands that are valued more than $10 million. And it's amazing that somehow today $10 million is not enough, or it doesn't seem like a big number. And to me, it's a huge number to be able to build a business up to $10 million. That's such a huge achievement. So these companies were all have made it into the unicorn alumni by starting off very organically, and have grown on bootstrap, and I've grown on sweat equity. Company like Linda, she started building a digital content, and grew it. Later was acquired by LinkedIn. Shopify, it was a group of developers that really were looking for a shopping cart, and realized, let's really build ones on Ruby on Rails, and we'll use it. After 6 years running and generating organic revenue, they went public Ipsy generated $150 million before raising $100 million. So these are companies that didn't start off with give me capital so I can grow my business. These are companies that started off with really good ideas. Shutterstock was a developer, was also a photographer, built up 30,000 different images, decided to put them online and monetize them, grew up to $2 billion in value, all organically. Simply Safe, I mean, they are a US brand. After 8 years, generated hundreds of millions of dollars in revenue before raising any money. Loot Crate, $100 million in revenue before raising capital. They started in a hackathon and charged a customer from day one. That was their plan. You know, in over a weekend, they started to make money almost instantly. GoFundMe was bootstrapped until it was valued to $600 million. These companies, again, operated for years. They generated millions of dollars in revenue before raising capital. They were all capital, they were all organic, and they were capital efficient with their money. So again, the counterintuitive is I can't start my business until or unless I have funding. You know, and to me, as a VC, and the VCs come in different sort of shapes and colors and forms, we will never fund someone in the mature stages, not in the very early stages, if they don't have any traction, if they don't have any revenue, if they're not good with capital or capital efficient, and waiting for capital or waiting for VC funds to actually get them to the next stage. This is a completely counterintuitive stage. The other thing that I get a lot of is the idea of someone building a prototype or an MVP and looking for friends and family validation. Most of the time, friends and family are the same ones that are also initially funding you. So you'd have to be really, reasonable and realistic that the results that you're going to get for validating your idea from friends and family is really not accurate. So, you know, statistically, if you throw an idea to your family, the chances are they're probably going to give you 9 out of 10. It's a great idea. It's a wonderful idea. We think you should go do it. If you start presenting it to your friends, then the score starts to come down to, you know, about 7.5. Now, if you present it to strangers, then you're really looking at a 6, or to me, it's just an average, you know, idea. So a lot I see, a lot of startups and a lot of founders, entrepreneurs, really going in a very small, closed circuit of, of people that they know and try to get validation. And based on that, to me, false narrative of false validation, they go off. And then we go back to point, number 2, immediately they want to raise capital. And obviously that's where things started to go wrong. I can't remember the name of the company, but a few years ago, I read a Harvard Business Review report on this most famous company that never existed. And this company had went out and did a survey of people, asking them, we're building this company and we're building this car. What do you think if this car has, ABS brakes? What do you think if it has cruise control? What do you think? And they started really throwing all of the different options that this car that they were contemplating building will have. And of course, they came back with everyone really excited. Wow, that would be an amazing car. This sounds really great. This is wonderful. Yeah, it sounds like a really good car to have. So the company went off and built this car, and they really could never sell a single car. So they went back to the same people and said, didn't we ask you if you like this car, if this is a great feature to have? And everybody said, yes, it is. But you never asked me if I would buy it. And that's the difference, is that getting validation of an idea is one thing. Someone buying it from you and being able to show traction is a completely different thing. And that's where friends and family validation, as again, seems intuitive, but it could be very counterintuitive to what your goal is. Another thing when ask a lot of the startups and founders is everyone is, and again, VCs ask, and again, I'm not a big supporter of that, is what's your exit strategy? And that kind of takes the vision and the traction and the goal away from the entrepreneur. Having a goal is important. Having that goal be one thing is very dangerous. I think especially in the early stages, you become so consumed, and believe me, you will hear different arguments against this, but I go with what I have seen work with sustainable companies rather than the one-offs, which are, to me, the outliers that needed to be taken out of the equation if we really wanted to look at the bulk of the businesses and the bulk of what is actually going to be is going to materialize out of any startup, out of entrepreneur. The goal for every entrepreneur is to build a sustainable business. That's the target. The target is to look, how can I build a business that lasts? How can I build a business that can change over time, that can pivot, that has some core values? Amazon, if you want to go back and look 20 years and you listen to interviews or opinions, Amazon did not have the vision to be the end all be all infrastructure to buy anything. Amazon, or to be the Amazon Web Services and the biggest data host, did not have the goal of, we wanted to go acquire tons of companies, did not even have the goal to go and have a global business or to build all these different distribution centers or to build a business that is Amazon delivered. Those goals never existed. They had simply one goal. We want to have a great customer experience to buying things online. When they started with books, later on, they went on to do toys and electronics. They were attacked by analysts. They were attacked by people saying, what business do you have in understanding how to sell toys, for example, or electronics? And the answer was, we don't really have any business. We don't have any knowledge yet. We can acquire it. But our focus is, we want to build a business that provides a great experience for consumers to buy things. And that was the goal. It's building a sustainable business. Another goal is entrepreneurs is exit is not the most important. There are a lot of businesses that are very large businesses that are still family owned, are still owned by one or two proprietors, and the business is growing, flourishing, and it's a lifestyle business. It has purpose. It has created economic impact. It had hired employees. It has changed lives. It had created products. It had innovated, but there's still a successful lifestyle business. And not every startup is eventually going to be sold. Not every startup is going to go into an IPO. But I would say good, sound, sustainable, successful startups can become very long-lasting lifestyle business. You have to throw the outliers out of scope. You can't say, I'm a unicorn, I'm going to be $1 billion, or I'm going to be an IPO, or I'm going to be acquired. There are other options other than these three, unicorn or being acquired or going IPO. So you want to get yourself out of that fixed mindset, this fixed mold, that for me to be successful, those are the results or the indicators of success. They're not. There's some, but they're not. You also have to understand that a company or a business, again, throwing outliers, would have an average run of 8 to 10 years before an event happens. So you'd have to be able to actually create a business that is sustainable for a long period of time. And a sustainable business also means that you have to have a business that can stand organically on its own. It's not a business that relies on this perpetual capital raise where if it disappears, you're destroyed. And that's very important in terms of putting together your exit strategy, but combining that with a different long-lasting strategy. One of the great examples, actually one of the companies that we were about to sell to Constellation Software. Constellation Software is a Canadian company. They do about 100 acquisitions every year. They're about $33 billion market cap. But they have a very simple philosophy, no different than how Warren Buffett summarized it here. Every company we buy, we will never sell. We're a publicly traded company, so every company we buy, we want to grow, and we will never sell any of our companies. That's a very interesting mindset. But that's a mindset that Warren Buffett summarized as saying our favorite holding in stock is forever. We're going to buy and we're going to hold forever. So the business should also follow the same philosophy. Sustainability of the business, being organically growing and organically dependent is the most important goal that you should have, rather than how do I get out of that business. The 1% myth is another discussion that I always have with entrepreneurs and startup founders when they come and pitch. I'd say 7 out of 10 presentations have this 1% myth, which is here's the size of the market. If we only get 1% of that, this is how much money we make. And this is really, a fallacy. There's no such thing as the 1%. If you're shooting for 1% of a market, you're most likely to get 0.001% of that. You should never build a business that addresses 1% of the market. You should build a business that is actually going to dominate. And the word dominate here, we're not saying universal domination. We're not saying that you're going to dominate even a country or a region. We're saying you're going to dominate the niche that your business is addressing. And then you have to rely on this network effect that gets you that multiplier to be able to go into other different, parallel areas, and then be able to monopolize on that niche. It's not appealing or attractive, or you think it's intuitive to VCs to be able to be lured by $1 trillion market, and I want 1% of that, and therefore there's a great appeal to that. The most important piece is to show how you can dominate a very small market and have a network effect to grow that. And again, not to over-exercise the Amazon example, but if we're going to build something, then we should really look at the ones that have created these models. Amazon didn't start off by saying, we want to dominate every single online transaction, online exchange that happens. We want to be the biggest company in the world. They said, we really wanted to be the place that everyone is going to come to dominate the book distribution and the book buying market. And we want to give people great experiences in there. And we really want to be able to be the number one in this very book, in this very book sale. And that have created that niche for them. Everybody knew what Amazon is. Then they started to monopolize that space. Then they started to expand and create this network effect to grow beyond just the initial monopoly and the initial market that they are in. These are the models that entrepreneurs and startup founders really need to follow. Not the intuitive, not the common, but rather the counterintuitive, the uncommon, to be able to see how is your idea quite different, how is your idea going to make it. Being an entrepreneur, and this is probably something that is not new, is not foreign to anyone who's joining us today who's an entrepreneur or considering becoming an entrepreneur. It is a long journey. If I use my personal experience, I've been at this entrepreneur thing for the last 20 years, from starting in companies and then building my first company organically. And it's a very, very long journey. It's a journey that you should enjoy. It's a journey that you should embrace some of the challenges in it, but it's a long journey. It's very it's very uncomfortable to see young entrepreneurs or young founders that are really not is looking to this as a sprint rather than it's a marathon that is going to be run, that needs discipline and needs sustainability. They want it in and out quickly, and this is sort of, I call it the microwave mentality. You want your food ready in 3 minutes, and it's not. It's hard work and it's physical work. By physical work, here, I mean, there are a lot of entrepreneurs and a lot of startups, and this is probably maybe this single red flag that I immediately dismiss as we will never invest in this, are the ones that have the idea, have the product, but they haven't really done the physical labor. They haven't gone out, engaged with customers, got on the phone, went and knocked on doors, sold the product. They're coming in and talking about things that we have people are interested. When we raise capital, we're going to go sell, then we're going to go grow. And to me, that's not really characteristic of someone who understands what an entrepreneur is. You have to do, personally, if you're the founder, it's on you to go out and sell. Your product or your idea is not going to sell itself. We talked in the last several slides of friends and family are not going to be the ones that validate. We said money is not going to be the one that gets your product out there. So you have to go and do the actual physical labor and physical work and the hard work on being turned down, coming back, pivoting and changing, going out again and trying to sell and sell and sell. Somehow in the world of startups and entrepreneurs, the idea of sales and distribution is sort of missed. There's focus on technology. And I can tell you, there's a lot of crappy products out there, but they sold a lot. And there are a lot of really good products they haven't sold. At the end, it's going to come to your distribution, is going to come to your sales. And that's a lot of physical work. You always have to inspect and adapt what is working, what is not working, and be able to actually create something tangible. I want to go back for just a few seconds on Amazon. And when Bezos said, well, the most important thing for us is to create this great customer experience. I never see startups or entrepreneurs actually describing what that is. Everyone has this generic idea of, we are going to have a great product, we're going to have a great customer experience, we're going to have great quality, but their idea of what a great customer experience is not even defined. It's not supported by policies, by procedures, by training, by learning, by understanding, by visualizing what that means. To a lot of people is, yes, of course. It's like asking someone, are you honest? Yes, I'm honest. But you don't really understand what that means. So for someone to say, we want to have a great customer experience without inspecting and adapting and coming back, and if you start to connect all of these bullets together, you really start to understand what it is to be an entrepreneur, is coming back and writing a policy that what is a customer experience? How do we deal with customers? How do we create good experiences, great experiences? How do we up that experience? These are all work that actually have to happen, documented, discussed, tested, validated. That's what hard work is. I see people that throw these terms out and they absolutely have no validation and no response to what does that mean, other than, well, we're just going to give them that. So that's the tangible, and those are the things that at the end of these, at the session, if you agree, obviously, is that's what you need to go and drill down on. What does that mean, course correction? What is the difference between course correction, pivoting, or completely abandoning your idea and starting something else? One of the things that really made me retract from entrepreneurs is when I hear someone telling me that they're a serial entrepreneur. And and again, without context, I don't understand what that means. It means that you fail 10 times, and then you've learned? Or does it mean that you've changed your mind 10 times and you've learned, or you've abandoned ideas because some other idea came along that you thought would be really cool and really better idea? So it's really trying to understand what a course correction versus a pivot means, and for you to question yourself sometimes before you get in, going back to the to the prior slides of validation or passion. Are you passionate about an idea that you know really, really well, a market that you understand in and out, and you understand the gaps, and you've solved this before, have seen people solve it, or is it just an idea? Being an entrepreneur and having a business is a constant validation and verifications. As we can see, the times now are running significantly on a much faster clock. Decisions and changes and shifts are happening in minutes or even seconds. If obviously we see a pandemic comes in, so constantly being able to validate and verify. I'm not talking about an unexpected event like a pandemic, and you should be planned for that. No one does. But I'm talking about other subtle industry changes that allow you to to validate and verify. This means the last bullet is important for me, is the self-realization and improvement. If we go back to all the different traits, characteristics, behaviors of an entrepreneur, those are things you'd have to constantly work on. If you don't have sort of self-realization, self-awareness of what your shortcomings are, what are you weak, and be able to find people that give you the support that you want as an entrepreneur, because there's an area that you're struggling with and you really are not the best at, you can't see a lot of improvement in yourself, in your thinking, then find someone that would come and kind of close that gap. Every great successful entrepreneur surrounds themselves with team members that are significantly better than him or her and have skills that the entrepreneur or the founder himself does not have. So this last piece is really very important, to understand what you're strong at, what you're weak at. Are the things that you're weak at, are the things that you can actually work on? Can you improve? And the self-realization, self-awareness will actually tell you whether you can improve or not, and whether you see tangible improvements, or are you just kind of lying to yourself. So again, it's exciting to be an entrepreneur. If I was to kind of summarize, I encourage people to have a sense of even entrepreneurial spirits, even if they are employees at a company, just to have that entrepreneurial spirit, but understand how to go about thinking of ideas, how to to pivot away from what is intuitive to what is counterintuitive, and try to balance both, and try to stay away from comfort zones that really kind of more protect you than allow you to expand. Like, I need money to do this, or let me go to some friends if they see would validate this, and again, all of these things that you have to put yourself outside of this comfort zone to really be able to know and get answers quickly, how successful you're going to be in your journey. I want to open the last 10 minutes for questions. Again, for me, I want to go back to really the core of this, and the goal of this session together is for you to go walk away and drill down and ask yourself more questions and explore more answers than just what appears to be the common and the ordinary. So I thank you for your time. I'll leave the last 10 minutes for any questions on anything we talked about today, or anything that was not covered today but maybe fall under ask a VC question. And I am on Zoom, so your questions, if you're streaming this on Facebook, if you post it, the moderator will actually send them to me in real time, so I'll be able to answer them as they come. So one question is, what encourages a VC to invest in a certain idea? Um, so, and they said if we can talk about an example here in Egypt. So every VC has their own sort of philosophies and their own vision, and I think there's a misconception out there that a VC is someone who has the answers. Um, I think that's a very dangerous and wrong misconception. I think a VC has experiences. I think a VC has exposure to a lot of ideas. I think a VC has access to a lot of deal flow, so to speak, um, and their own interests. So if you kind of combine all of those in the life of a VC, if I kind of give you like access to what my day or my week looks like, there's a lot of discussions with other VCs. What are you investing in? What are you looking at? What are you finding interesting? So that's in one bucket. There's the constant flow of different proposals and different pitches. So you're constantly learning some of that and understand and getting educated on certain markets and educated on certain problems. And then there's your own sort of reading and research and reading market reports and trends and industry changes or industry dynamics. And so if you put all of these kind of together, you'll find that the VC is really no different than an entrepreneur, other than, in terms of having the right answer, other than we have access to just a lot of data. So it's kind of left to try to combine all of these together. But certainly some of the things that encourage a VC to look at a certain idea is some of it you can look at historical, has that, and if you do like sometimes in like in an RFP or in a proposal, you have these very objective measurements to say I'm going to give weights to a lot of these different areas. So I'm going to give weight to the team. Has that team been successful before? Has they not? Is this their first venture? So you're going to give that a weight. The technology, is it a deep tech in there? Is it something different? Is something unique? Is something proprietary? So you look at again at evaluate the technology. Then you look at the industry, and then you really look at kind of the marriage of all of these togethers, plus obviously kind of some of the market and the social behavior. So at the end, you're going to look at this and there are a couple of different approaches to VCs. Some VCs blindly will follow a specific maybe accelerator or a specific investor and says, if this investor has a higher probability, I think most of my answers are answered. Is it just the right economic for the deal and whether I want to go in or not? Other VCs don't really look at that, and they look at kind of their own portfolio and see, is this synergistic with my portfolio? Can I get distribution and this traction? Do I have past experiences that tell me whether this is something that have worked in the past or have not worked in the past? So as you can tell, there's just a lot of different variables. There's a lot of also intangibles. I don't want to kind of really underestimate the likability of the team, the ability of the team to execute. Have they executed? Have they shown traction? So if you put all of that together, you can see that the answer to this question is really not as black and white. If you have 1, 2, 3, then you're investable. If you're not, if you don't have them, there's a little bit of a combination between sort of objective views and some of the subjective views. For me personally, does the idea have traction? Have this traction been proven, or can the team execute on this specific idea, and is the market there to receive it, and is there validation for that market or not? So we try to stay away from the sort of very objective views of team skill and talent and commitment. We're kind of, you assume all of those, or at least those are the minimum requirements. But to me, the most important is that, is there traction in that startup? And if that startup is showing traction and it's legitimate traction, then definitely they are investable. And to put a quantitative answer to this, for me, traction is, if you're a startup and you have a product and you're out there selling, and you really need to show that you're growing at about 5 to 7% every week. And that's pretty aggressive, but that's what traction is. Traction is not intermittent. Traction is not, I have one customer, then waited 3 months and I have 2 customers. Traction is a consistent and pattern-based growth that you can show that week after week. And you can see the increment here is in a week, not in a quarter or a year. You're not a 30-year-old company that is going to measure the growth on an annual basis, but actually for me, it have to be measured on a weekly basis. Are you from a week to week showing traction? Is there adoption? Are you responsive to the customer feedback from your product? Do you have a product roadmap that can build on that? Do you have a network effect? Can you be a monopoly? So those for me are some of the highlights of choosing a team and choosing an investment. So I know we're coming up on just 4 minutes. There might be another question. Okay, so that really was it for our session. Thank you for having me. Thank you for attending. My email, if you have any questions, is really very easy. It's ash, ASH, at opener with 2 N's, OPENNER.VC. Happy to answer any question. Happy to give you feedback and advice. Thank you so much, and we appreciate you being here with us.